My name is Craig Floss, and I have the privilege of serving as the Chief Executive Officer for the Iowa Corn Growers Association and the Iowa Corn Promotion Board. And it's no surprise that we're going through some interesting and challenging times in agriculture. So I'm especially pleased this morning that we're joined by two very respected prognosticators who are going to tell us what the future holds. First, our guest is Mike Blackford. He's a senior consultant with FCStone's Renewable Fuels Group. Mike normally brings his 30-plus years of commodity risk management experience to bear while advising clients, but today he's going to be sharing his insights with us. And next to Mike, we have Iowa State University Associate Professor of Economics, Chad Hart. Chad was gracious enough to fill in on very short notice, as I regret to say we found out very late Friday afternoon that duties in D.C. would prevent USDA Chief Economist Rob Johansson from coming to Iowa. And as you may know, USDA leadership is short-staffed. You heard from Monty and Eamon this morning. So Rob is actually doing both his job and the job of our own Bill Northey and what he should be doing. So remember to free Bill, hashtag free Northey outside. Take that photo and please be tweeting it out. Regardless, we're very happy to have Chad here. He brings a wealth of experience in this area. His full bio is on the back of the program, but I'll highlight that his work for ISU's Center for Ag and Rural Development put him in the middle of modeling of how both biofuels and trade impact agriculture. So before we begin having our conversation, taking some questions, Mike is got a brief presentation, and so Mike, the floor is yours.
Okay, thank you, Craig. I want to thank the association for allowing me to present the current ethanol situation and to be on today's panel. Quick story though, I was at home working on this presentation, getting it all ready, trying to go through my notes and everything like that, and my wife goes, so what are you doing? I said, I'm getting ready to speak to about 200 plus people tomorrow. And she goes, well, don't screw up, you know. So anyway, so it's like, thanks dear, I love you too. But the situation is that, you know, we're entering a new time, and I'm going to give you my take on the current ethanol situation right now. So, unfortunately, the theme right now is the good, the bad, and the ugly. And after last week's energy report, the weekly EIA ethanol report, perhaps we went from ugly to uglier. But folks, no concern here. It's January, and January is typically a somewhat bleak month for the industry, not only for ethanol, but for biodiesel. It's very, very short on demand this time of year. So the best thing about going forward is we're getting January behind us. I want to start off talking about ethanol stocks. We ended 2017 with a record level of 950 million gallons. Based on demand, that's 21.7 days of supply. The normal is 20.4. Now, that 1.3 days may not sound like a lot, but to the industry, it may be as much as a nickel to a dime in margin. So I want to move into how we got there, and it's simply from production. Production is growing at a rate of over 3% a year. We ended up 2017 with a production number of basically 15.9. It's consuming roughly about 5.6 billion bushels of corn. Now the trend suggests that 2018's production will reach 16.2 billion gallons. Achievable? Yes. We have in the works, through expansion and new construction, the ability to produce about a year from now, we'll have capacity around 16.3. Now a typical run rate on an average annualized basis, 102%. So production could easily climb in about a year from now around 16.7, 16.8. At the maximum run rate, we can run at 110% of capacity. That gets us up to and very close to 18 billion gallons. Again, this is a year from now. And hopefully we get there. That would consume 7 billion bushels of corn. Okay, so you can't talk about supply and production without looking at the demand side of the equation. And right now, this is concerning to me. Between 2010 and 16, we've been growing at a rate of about 1/3 of a billion gallons a year. I got a typo up there, but that basically 1/3 of a billion gallons per year. Now, 1 year doesn't make a trend, but 2017's demand for ethanol was flat versus 16. Part of the reason, in my opinion, was on the gasoline side. Gasoline consumption was down 0.5% in 17. Retail gasoline prices curtailed that demand. The prices were 28 cents higher in 17 versus 16. So we could have actually been worse, but the U.S. economy was strong enough to support some demand there. Now, looking at the forward gasoline curve, it suggests retail prices will be up another 20 to 25 cents a gallon. So, in my mind, we could be looking at another situation where gasoline consumption is down, i.e. this time we actually may see a draw in ethanol demand as well. And why do I say that? It's because of this, the blend wall. Technically it should not be there, but realistically it is. The 5-year average blend percentage is 9.75%. Last year, that number went to 9.85%. Yes, so we may be gaining a subtle amount, but we're still having a difficult exceeding that 10% limit. Which kind of brings me to this next topic, and I think Monty covered it as well, but, you know, an RVP waiver on E15 summer use is a must. Up on the graphic, I'm showing basically the EIA's projection in gasoline consumption over the next several years. We're going to have a subtle increase over the next year maybe, but in 10 years from now, we're looking at a demand structure that's 20 billion gallons less, down to 120 billion gallons annualized. And if we stay at that 10% blend, I tried to show that on that orange bar, that we may only need 12 billion gallons of ethanol to meet the domestic consumption demand. Don't forget, you know, this is 10 years down the road. The RFS goes through 2022, so that's only 5 years away. So we may not have the RFS there to support us, but we shall see. Now, so moving on to E15, if we can get the E15 waiver, I see consumption rising to 19 billion gallons. It's not going to happen overnight, but the possibility's there. But again, my bigger concern is that forward-looking picture of gasoline demand, where it steadies out at 115 billion gallons. So even with the E15 waiver and we get to that 15% blend, we may be only looking at a consumption level of 16 billion gallons of ethanol. So my point is, we can't stop at E15. We must press forward and look at other blends. We also need to look at the export market. Speaking of exports, this graphic shows you the top 10 buyers of ethanol last year. Number 1 is Brazil, and these numbers are through November, so they're not quite the complete tally. We'll get December's numbers next week, so that complete the year. But Brazil was number 1, taking about 1/3 of our export gallons. And what's interesting there is 5 years ago, the world's number 1 ethanol exporter has now become the world's number 1 ethanol importer. But we're seeing growth in Canada. The Philippines are there. India's given us some strength as well. But these 4 countries essentially make up about 80% of our demand. So 2 of those countries are major sugar producers. Sugar values are down 40% from a year ago. So it's my expectation that we'll see less ethanol going to Brazil as their sugar plants switch from producing less sugar to more ethanol. The tariff hurts us or hinders us as well. However, we continue to grow our export picture. We're growing at 22% a year. Last year's exports reached almost 1.4 billion gallons, or 500 million bushels indirectly of exports. 500 million gallons, essentially 20% of the Iowa corn production. And this trend, suggests that 2018 exports will reach 1.6. I think the number is going to be higher than that. I think it's going to be closer to 1.8. Yes, this is even despite Brazil taking less ethanol from the U.S., but we now have sometimes they use the phrase 800-pound gorilla in the room, China. China is expected to take 600 to 800 million gallons of ethanol this year as they proceed or attempt to reach their 10% nationwide mandate in 2020. So a bright picture there. So I appreciate everybody's time. I thank you, and we'll continue.
All right, well, thank you, Mike. Appreciate that presentation. I'm going to start in with some questions, and the format this morning will be I'll ask a question and ask each of you to respond to it. My first question, some economists think that corn prices will stay below the cost of production for the foreseeable future, barring any weather events. First of all, do you agree? And if so, what does that mean for the future of family farmers? Mike?
Okay, I do agree. We're fortunate we did have a good crop last year, almost just 1 bushel shy of record yields in Iowa, so that helps out a lot. But the price pattern in corn over the last 3 years has been basically $3.25 to $4.25. So not much change at all over the last 3 years. We've got to get the carryout in corn below 2 billion. It's currently at 2.4. We've got to get it below that in order to see a sizable increase in values. But if that does take place, I think values of corn could reach $4.50 a bushel at that point.
All right, Chad, your thoughts?
Well, and as you look, as Mike alluded to, when we look at the sizable production we've had in the corn market over the past 5 years, it's been this case of supplies exceeding the great demand that we've got. As has already been mentioned here, and as Mike pointed out, the idea is when you're looking at the ethanol side, we're seeing continued 3% growth over the past few years, actually, and the projections going forward. When you look at our livestock industry, they're growing at 3 to 4% as well. And so our demand side, when we're looking domestically on the corn side, has been very strong. And the problem has been, for lack of a better term, oversupply in the marketplace. And that's been the pressure that we continue to see building on this crop market as we look going forward.
So specifically then, relative to the question about the family farmer, what are you seeing out there, Chad, relative to that situation?
We are seeing tightening farm financial supply situation here. When we're looking at our typical Iowa farmer, we have watched their cash reserves decline over time because these low margins within the crop markets have had an impact on family farms. We are seeing more debt build up within our ag communities here. We are seeing some land begin to move around because of those tight financial situations. And so this is a slow erosion, if you will, of the returns that we had 5 years ago due to the push that we received from biofuels.
Okay. Any follow-up to that, Mike, from your perspective?
No, it's just more of the same efficiencies. Put your marketing plans together, your purchasing plans together, have realistic expectations. It's a cycle, so we got to just weather the storm.
Okay. So given that corn prices are generally mired below the cost of production, do you see a continued reduction in corn acres?
The problem is right now USDA looking at 2018 actually projects a slight increase when we're looking at corn area. I've called it the Iowization of the U.S., What we have seen is acreage moving out of wheat and cotton specifically and headed towards corn and soybean production. And as USDA looks into this year, they see that continuing as we look down the line, mainly because other crops are suffering the same sorts of low returns that we're seeing for corn and soybeans here in Iowa. In fact, I've described us as we have the best house in a bad neighborhood right now. The idea is while our prices are down, they still look relatively attractive to the vast majority of farmers across the nation.
Okay. Any thoughts on that, Mike?
Well, the American farmer likes to grow corn, right? So you don't have that many opportunities to get 300 bushel an acre. So it's about market economics. We're going into the pricing period here this coming month, averaging the insurance price right now suggests corn over beans, beans over corn. So we'll see how that plays out. But, one other thing, and I think Chad alluded to it, but, cotton prices have gone up 25% since last fall. So we're likely to see a little bit of a shift down south away from corn acres in my mind. So.
Okay.
In a certain sense, I think that's what we're looking for. Is one of the things that could help the corn market is to see a few acres go to other crops as we're looking out there.
So speaking of shift between corn and beans, can you each give us your thoughts on where the future of the soybean market's going?
Soybeans, much like corn, just we're heavy on production, heavy on supplies right now. We've been a stagnant trend. It may be a 50-cent trend here or there, or, choppy trend sideways, if you will, in beans, but can't expect much out of it. Again, the economics that I've seen so far, analysts are suggesting that we'll have 1 million more bean acres this coming year. We're going to grow the stocks, things like that. So of the pictures, perhaps beans looks a little heavier than corn, to be honest with you.
Okay. And just a quick follow-up on that, Mike. If we're seeing 1 million more bean acres, and what Chad said earlier, you're assuming that's not necessarily coming from corn with the slight uptick in corn acres. We're actually seeing that come from other crops. Is that what the projections are?
When you look at USDA's numbers, definitely. The idea is wheat especially has been the crop that's lost the most area. We've also seen some retreat in some of our smaller grains and smaller oil seeds to open up room for, in this case, especially soybeans out in the Great Plains. One of the big areas to watch there will be North and South Dakota. Over the past decade, especially North Dakota has really ramped up soybean area. In fact, they were 7.5 million acres up there last year. That's up about 6 million from where they were a decade before. And at least the chatter up there suggests that they could be looking at 8 million acres in North Dakota alone. And so we are seeing, like I say, a strong concentration in area outside the traditional corn belt coming into corn and soybean production.
So any other thoughts, Chad, from the soybean perspective and the market outlook?
Well, one of the things about the soybean market and what has helped push it along has been very strong demand. And one of the key words that I've heard through the opening sessions here, trade. When we're looking at the soybean market, over half of our soybeans that we grow in this country are shipped to other markets throughout the world. And especially in this case, China. China represents 60% of our export trade when you're looking at the soybean market. Or to put it in dollar terms, $14 billion worth of soybeans leaves the U.S. and goes into China each and every year. And that has been the strong demand pull that has helped propel soybeans to 90 million acres. And that's I would say, the impetus of why we continue to see growth there this coming year.
Okay. So next question. Senator Ted Cruz and others continue to try to use every trick in the book to roll back the RFS. His RIN waiver scheme would allow obligated parties to buy their way out of blending for only 10 cents per RIN. Now, some economists have determined that this would effectively eliminate biodiesel and cellulosic ethanol demand from the RFS. Do you agree?
I got to admit, I do agree that when I'm looking at, especially as you mentioned, biodiesel and cellulosic ethanol, the RFS is a crucial piece of legislation for those fuels. Going back to Monty's opening statements, when we're looking at the development of our fuels, biodiesel and cellulosic are still relatively new fuels. We're still, if you will, refining the technology, improving on the technology to make them cost competitive within the fuel market. And that's what the RFS helps do. It helps protect those industries, allow them to develop that technology that can compete in the fuel market. And when I look at corn-based ethanol, you've seen that industry mature over the past decade, especially due to that help through the RFS to where it is very cost competitive now. I think we're looking for that same sort of pathway as we look at our other fuels.
Any thoughts on that, Mike?
Yeah, I would agree. I mean, it's going to be, it wouldn't eliminate things, but it would definitely put us in an uncompetitive environment whenever we look at biodiesel and the cellulosic ethanol. You know, and the whole purpose of a lot of this, the RINs, the purpose of the RIN is to be that variable credit to help us compete. It's supposed to fluctuate based on our supply and to make sure we achieve those goals that have been set out. At times, I don't believe that process is working properly. I can look at an S&D, or I try to compile an S&D on the RIN situation, and it just doesn't make sense. I go blank, to be honest with you. So, you know, it's very essential to have that RIN out there to give us, again, that competitive edge and increase our demand.
So if this happened and we actually lost some of the cellulosic and biodiesel numbers being blended, would it also potentially allow the oil companies to use less than 15 billion gallons of traditional ethanol? And if so, would you see ethanol usage drop?
I would say the potential's there, but when I look at what I see in the market dynamics, I think corn-based ethanol has found a way to be cost competitive against petroleum. And as we look out there, I see, you know, right now, for example, I'm looking at fairly steady ethanol pricing while gasoline prices are moving forward. And I think especially your independent retailers are definitely looking for any cost advantage that they could pass on to consumers as they look forward into 2018. And one of the cost advantages they can provide is through the use of blended fuels, the use of E10 and E15 to help, if you will, bring that car back into the convenience store.
Okay. Your thoughts, Mike?
Yeah, less of effect. You know, we're already up to, I think, you know, it's just a mainstay anymore. You know, we utilize the ethanol just to bring up our octane and things like that. So it is a minor effect, but I'm kind of under the contention that, you know, if the RIN goes to zero, but as long as you give us the E15 waiver, I'm good with that. So.
Okay. Let's turn a little bit to trade. As we all know, and was mentioned earlier here today, a lot of discussion about NAFTA. President Trump has threatened, in fact, to pull the U.S. out of NAFTA if it's not a good deal. If that happens, what's the likely impact on our commodity prices? And whichever one of you wants to go first, have at it.
I'll dive in first. When we're looking at NAFTA, I think you have to look at it in its totality for U.S. agriculture. Combined, when we're looking at, I want you to think not just Mexico, but Canada. You're talking about our second and third largest agricultural trade partners. Based on 2017 data, you're talking about those two partners being worth roughly $40 billion to U.S. agriculture. When I concentrate it down here to Iowa, the rewards, if you will, are even greater. For example, when we look at the corn market, our number one export market there is Mexico. When we look at our soybean market, our number two export market is Mexico again. And when you look at distillers grains, when you look at ethanol, we find Mexico and Canada often are in our top five as far as our trade partners there. And so NAFTA is critical to us when we look at both U.S. and Iowa agriculture, and I would argue the biofuel industries. When I look here, the idea is that that's how we've helped develop and grow our markets. I think that's one of the things that really jumped out at me in Mike's presentation, is when you're looking at where the strong growth has been over the past 2 to 3 years within our biofuel markets, it has been the international trade component that has really sort of led the charge. And I think that goes back to the idea, especially for corn-based ethanol, that it has been able to become cost competitive against petroleum. And not only are we seeing our usage grow here in the U.S., but that's driving the demand we see overseas.
Okay. Mike?
Yeah, you know, I think we've built a demand base into Mexico and Canada, I just, I think if there's a will, there's a way. You know, back in 1973, I think the Russian wheat embargo, it was indirectly fed back to the Russians through Italy, I believe. But wheat prices went from $2 to $6. So it's really difficult to say what NAFTA will do to us or revamping NAFTA. But my contention is the demand's there.
Okay.
So it's just a matter of getting there.
So Chad, you hit on this a little bit on ethanol and biodiesel and maybe some DDG sales to Canada and Mexico. With pulling out of TPP as we did and other trade agreements, what do you think the future is and what challenges do we face as we try to export ethanol, biodiesel, and our distillers' grains relative to the trade agreements that either are or aren't there?
Well, that's the deal. When I look at, for example, NAFTA, what NAFTA has done is allowed us to build some very strong trade relationships with our partners there. With our withdrawal from TPP, my concerns are more about that those other countries are moving forward with TPP with us sitting on the sidelines. And so those 12 countries that are agreeing to TPP are going to have preferential, if you will, trade rules with each other, where the U.S. is sitting on the outside looking in.
And now China's right in the middle. What do you think about that?
Well, that's the deal. I think you see China now trying to step in and become that, if you will, driving player in some of this discussion. Where we had that role before, China's now trying to sort of take that role as we change our trade rules as we look in here. And I think that is a concerning factor right now. When we look at President Trump, I think we elected him with the idea of he's a businessman who's going to be able to maintain and hopefully grow our trade relationships there. We're still hopeful that that's the case, but looking forward, that's going to be the dynamic, is we're in a very strong competition now for that international trade, and trade agreements have been the big way that we've driven our relationships there.
Okay. What do you think, Mike, on trade?
Well, like I presented there earlier, but Canada is our number 2 ethanol buyer. They're very consistent, 300 million gallons a year, so very consistent there. Mexico, they are a buyer, but they're one of those countries I think we can identify that's going to grow. So we'd like to see that proceed. And let's don't forget that, and I think Chad alluded to it, but they are big buyers of distillers, taking 25% of our market between Mexico and Canada. So very strong there. Canada, easily by far the biggest buyer in biodiesel. Okay. Now the reciprocal of that may be, it deals more on the biodiesel side, but we do utilize a lot of canola oil for the biodiesel process. So we may have a situation where those to the north may be short feedstock, if you will, on the biodiesel side. So.
All right. Countervailing duties have been placed on illegally subsidized biodiesel imports from Argentina. In conjunction with the flatlined RFS level for biodiesel, how will that impact U.S. biodiesel production and commodity prices for soybean oil, corn oil, and animal fats? What do you think, Mike?
Okay, so Argentina basically exported about 250 million gallons of biodiesel to the U.S. The immediate effect would be we'll have to make up the difference, right? So about 1.9 million pounds of additional oils, if you will, should be supportive. When we first talked about the countervailing duties and putting them in place, oil, bean oil in particular was around 36 cents. We've fallen off since then, but that's very seasonal. I expect values to increase as we get back into springtime production on biodiesel. So we'll probably go back to 36 cents. We're right around 33 right now. So.
Any thoughts, Chad?
Well, and one of the things that we've seen when we look at the biodiesel data through 2017 was that as soon as basically the countervailing duties were announced, we did see a dramatic drop-off in biodiesel imports here into the U.S. In fact, when I compared 2016 to 2017, imports were cut in half. And so there was a very immediate impact within the marketplace once those duties were announced that very quickly it was, if you will, absorbed into the market.
Let's turn to China. China has a new national ethanol mandate that expands E10 use from the 11 provinces to the entire country by 2020. This policy would boost ethanol demand by roughly an additional 3.6 billion gallons. So will China be able to satisfy this new ethanol market with its own production, or will the U.S. have a role in supplying this new market? And if so, what do you see as the long-term reliability of this multi-billion gallon market? So, I'm sure you guys have all the answers on China. So.
All the answers. I think when we're looking at China, what you're seeing is it'd be a massive change for them to move completely to E10. When I'm looking at it from their perspective, it's a way for them to utilize their corn stocks that they now have built up. Craig, as you well know, the idea is when we look at the world totals on corn stocks, we see China as always the leading figure there. They have a tremendous amount of corn in storage right now, but they're also looking for ways to utilize it before it goes out of condition. And so they see the building up of the ethanol industry as doing that. But I think we also see opportunities for the U.S. to enter into that market. As I look and as Mike's data showed, the idea is we've went from being just a large producer of ethanol to now the world's largest exporter of ethanol. And China is a market that I believe we'll be able to crack into and go into. And the other thing that fascinates me about what China is doing is I know at least one of their plants is dedicated to looking at cellulosic ethanol as well. So you're going to see them explore like we are right now. How can they develop other feedstocks to help feed that ethanol mandate that they have?
What do you think, Mike?
Well, I think the number is close to 4 billion gallons, to be honest with you. So they say they want to be self-sufficient. They currently have like 80 million tons of corn in stock right now. It's down considerably from 3 years ago. I think down about 25-30%. But they could still probably alleviate another 30 million metric tons. But that 30 million metric tons makes up that ethanol difference. It gets them to 3.5 to 4 billion gallons or thereabouts. So that's just 1 year. So as they move forward, I could see U.S. or the total demand being a couple billion gallons. The U.S. probably won't get all that. It's probably going to be seasonal. You know how China does on their grain purchases. They'll buy half the season through the U.S., the other half through Brazil, that type of thing. So I see a similar pattern there. But nonetheless, I think the U.S. can overtake 2/3 of that market share, be roughly about 1.5 billion gallons. Again, they think they're going to be self-sufficient. That's their goal. Their corn yields are roughly about 100 bushel per acre, I believe. Mm-hmm. So we know how that compares with U.S. The U.S. average is 176 last year. So they have room to grow there. They don't have the plant capacity. They say they're going to build it. It's kind of interesting. I saw a story several months ago, I guess, really, but they've started the first process of building a new plant. It's going to be roughly 200 million gallons. But the interesting stat there was they were going to employ 3,000 people. So our typical plant here may have 30, at max. So it's going to be a big market. It's one of those golden nuggets that we've got coming for the industry. So
I think the other thing that's going to be fascinating about China is they're willing to explore other feedstocks. And in fact, in looking at some of the press releases I've seen coming out of China, and I got to admit, I'm having these translated by some colleagues of mine at Iowa State who can read Chinese. But they're saying that what they're targeting, at least, or what the government is saying, is that they're looking at roughly 2/3 of their ethanol being met by corn, with the other third coming from some other feedstock, whether it would be cellulosic or specifically they're looking at sweet sorghums, cassava. They're willing to explore a variety of other crops to help meet their needs as well. So it won't just be necessarily just a corn story as we look at what's happening with China and ethanol.
Earlier, Chad, you mentioned the condition of the Chinese corn, and I know in my visits to China, the storage capacity is not good, and what they do have for storage, it's very marginal in terms of being able to keep corn in condition. How do you think that ultimately plays? Any insight there as to how that impacts their ability to use it for livestock feed, let alone for ethanol production, and get any kind of efficiencies out of a plant?
Well, I think that's the other thing they're really going to struggle with. As they look, they would like to use those stocks. They recognize that an ethanol plant does need a certain quality of corn. And I think that's one of the areas where U.S. corn is looking for an opportunity to possibly come in and serve as, if you will, for lack of a better term, a blending agent. How do we blend up some of these lower quality piles that they have to make it to a, let's call it average blend, where we can utilize it either as livestock feed or as biofuel feedstock.
Okay, very good. And just as an aside, I've also heard that they intend to power some of these ethanol plants with coal. And so I really question, I don't know if either one of you have any insight into this, the carbon footprint of coal-powered plants. And we have them here, but I wonder about their technologies and their ability to actually make it so that the carbon footprint is lessened. I know what they're trying to do with ethanol to clean up their air. Do you think they can achieve it based on the technologies they have today?
I think they're going to try. I mean, I think when we're looking here, it's what's going to drive how they build their plants and what they use to power them. We'll go back to what they have on hand, what can they utilize, and build fairly quickly and cheaply. When we look at the reason why our plants developed, we started out the industry mainly coal-based, and now we're mainly natural gas-based, but I would argue that was because of a change in the market structure on the energy side, where starting out, coal was that cheaper source, and as we've moved forward, natural gas supplanted it. We could see those same sort of shifts in China as we're going forward, but here I think you do bring up an interesting challenge for them. They are moving to biofuels to help clean up their air, while at the same time, too, cut in the same sort of catch-22 we were in 20, 30 years ago.
All right, let's turn to Brazil. They've recently thrown up a huge trade barrier for U.S. ethanol, such as the 20% import tax on U.S. ethanol. How do you see this impacting demand and commodity prices? Mike?
Well, it's no doubt it's affected their import from U.S. Since they announced it, they've taken in about half of what they did a year ago. So it is a barrier. I think I alluded to it, but sugar prices are a little bit of a problem for ethanol going there as well. But what's interesting there is we're hearing some talk now they're going to eliminate that tariff. Now part of that is because gasoline prices are taking off, and their feed, their blending agent is high priced as well. So they're wanting to. There's been a lot of talk down there that they may eliminate that tariff, and that puts us back in the game. So the economics are there. 30 cents to 40 cents a gallon right now. So there's definitely a strong opportunity for U.S. product to continue to go there, just in lesser amounts.
Okay.
Yeah, and I'm going to wholeheartedly agree there. When we look, the tariff has had an impact. As Mike mentioned, has cut those imports by about half. But the idea is that there is chatter that they are going to reduce that, and as they reduce that tariff back down again, I think we'd see that market pop right back in again. In fact, it's an interesting two-way trade we have with Brazil when it comes to ethanol, because that's, when we're looking at the renewable fuel standard, there's still some Brazilian ethanol moving up here because of that. Okay. And that opens up, if you will, that continued opportunity for two-way trade between the two countries for biofuels.
So staying on the trade topic, both corn and soybeans have lobbied for and been a recipient of the public-private partnership that is MAP and FMD through the Farm Bill. The biofuels industry is supporting greater funding for both MAP and FMD as well. If lower-cost ethanol replaced MTBE around the world, demand could be increased anywhere from 1 to 3 billion gallons. My question is, would the U.S. commodity market be able to handle that, and ultimately would farmers benefit?
Okay, I think we can handle 1 billion gallons, maybe 2. We do have this new capacity, and production will be strong. But no, I mean, it's essentially, it could amount to, with this 3 billion increase, or even higher, could amount to 1 billion bushels of corn. All of a sudden, you're getting that corn carryout down and everything, and corn prices should benefit from that standpoint.
Okay. And that's exactly the type of growth you want to see. I mean, I think anytime we can grow demand for biofuels, for our underlying commodities, That's exactly the type of trade promotion we would like to see as we look out there. And so could we handle it? Short run, it would be really tough. Long run, no, we're ready to build, to grow, to do that. In fact, that's one of the more interesting things as I look at the biofuel industry right now. We're beginning to see those signs of growth. We are beginning to add new plants for the first time in a couple of years. And so that shows me that there is this demand building growth out there that can be had, and hopefully we can promote it through our trade work, through programs such as that are in the Farm Bill.
So Mike, in your earlier slides, you did touch on the year-round sale of E15. Could you both of you speak a little more to what kind of an additional gallons you think that might, just reiterate what that is, and what kind of impact you think that might ultimately have on price and farm income?
Yeah, so the quick and dirty answer is that we go from 14 and add 7 billion gallons to the equation. So it would take care of our corn carryout problem. Again, this won't happen overnight, but it is that one item. I think it's almost easily could be solved. I think there's some hang-ups for the legal definition of what E15 and whether it's can be used, but I think it's there. It's just a matter of time. So.
Okay. Any other thoughts, Chad?
Well, no, I think what's interesting to me is when I look at the growth of E15, especially here in the state of Iowa. I joke, since I'm an extension economist, I spend a lot of time on the road, and so my favorite thing to look at for now when I'm in a convenience store is, especially with come and goes, it's the blue handle and the blue hose, because that's that E15 pump. And invariably, when I see that blue handle and blue hose, I see a car in front of that pump because of the cost advantage we see there. And so when I'm looking at how this industry is going to continue to grow domestically, E15, I would argue, is one of those easy ways to grow, where the cost advantage is there, the vehicles are already set up to utilize it, 2001 and newer, we're ready to go, and so it makes sense to continue to push to grow that way, since it works well for both the industry and the consumer.
So we're going to hear a little later from an expert on the growing role of electric vehicles, or EVs. Have either of you looked at how electric vehicles may impact liquid fuel demand in the future, and how will that affect biofuels and the commodities they are made from?
I haven't actually done any sort of formal study here, but as a man who drives a Prius, and to answer Monty's question from before, I'm going to go the plural Prius is Prii. But as I'm looking here, I think what you're going to see here is, let's call it a slow evolution. I think when I'm looking at electric vehicles now, let's call them a novelty item. Monty mentioned his daughter would like to have one because they sound new, they sound cool, fun. In fact, the one time I've got to ride in one was an Uber ride up in Ames in a Tesla. But I think when you're looking at those electric cars, the issue is going to be how well do they fit within the U.S. consumer's approach to transportation. For commuting short trips, electric cars can do that right now. But what they can't do is basically the long, any sort of decent sized trip when you're looking around and be able to recharge quickly. That technology will slowly develop over time, and so when I'm looking at the impact that electric cars will have on us, I'm not expecting it to be in the next 3 to 5 years. I'm looking more down the line of 15 to 20 years as that technology improves.
Okay. Mike?
I haven't looked at it. It's an interesting concept, but when it gets down to it, I'm sure there's several people out here that drive a Super Duty F-250. How's that going to work from an electrical standpoint? So it's most likely going to put a cap in our overall fuel consumption. There's no doubt. So, but like Chad alluded to, it's going to be a very slow process. We'll just have to see how things unfold.
Okay.
And this is where I'll flip it one more time. When we think about some of the ways we've looked at utilizing agriculture in the fuel market, electricity is one of the areas where we've looked to develop as a feedstock there as well. And so I think we could continue to see that push. So I always joke that when I'm looking at agriculture, we've always been in the biofuel market. Back in, I would argue, the 1930s and 40s, our biofuel was oats to power the horses that, if you will, were our machinery on the farm. Now it's diesel, biodiesel for our tractors, and if it becomes electric down the line, I would look to see agriculture as being the main feedstock to help fill that niche as well.
All right, staying on the future theme, let's talk about this. The EPA has come forward with some new pathways for cellulosic ethanol. Many companies who are here today provide this new breakthrough technology to the ethanol plants. And looking forward 5 years, what can these companies expect to gain from the use of this technology, or what influence will these new pathways have on demand for ethanol? Thoughts?
Well, you know, we are seeing a lot of that technology take place. It's helped in efficiencies quite dramatically. Obviously, we're trying to get the most and maximum ability out of that kernel of corn. From the technology that I know of, it's increased yields by about 5%. So it works. I think further on down the line, you know, it also means more cellulosic ethanol. And, you know, one of the bigger adjustments that the EPA does every year is they lower the cellulosic requirement simply because we don't have enough production. So this pathway or this technology should clean up that, give us plenty of cellulosic or some additional cellulosic production, that so much so that the EPA can't lower that requirement.
Well, I think anytime you expand the number of pathways that can help develop the technology, it helps again. Because I come back to, again, when I'm looking at the biofuel, I think the target is, can we create a technology that can compete in the free market with petroleum? And each new additional pathway opens up more possibilities to create that cost competitiveness. And so as I'm looking down the line 5 years from now, yes, having these new pathways should help for continued growth in this area. Because going back to Monty's original statement, these are our brand new fuels. This is where we're still, if you will, learning and refining the technology, figuring out how to bring that cost structure down to be competitive.
Very good. I have one final question, and I'm going to invite those of you who may have a question. We've got 2 mics in each of the aisles here, so while I'm asking my final question, if you have one, please step to the mic and we'll recognize you in a moment. So my last question for each of you is, what are the major challenges facing the ethanol industry today, and what do you think are the biggest opportunities? Mike.
Okay, so most of the challenges that were presented today are short term. We're overproduction, high stocks. I think the longer term aspect is quite strong via the E15 model or export-wise. You know, as I look at various countries, I mentioned Mexico, but Canada is also moving to at least a 10% blend. They're currently at 5.5%, 8%, whatever, something like that. So there's really strong potential export-wise. I can account for about 7 to 8 billion gallons of export potential on the ethanol side. So I think the opportunities are out there via E15 and the export markets. And again, the situation today, we're heavy stocks, but it's all short term in my opinion. So,
yeah.
Future, Chad?
When I'm looking here, I'll go back to both the, let's call it the challenge and the opportunity. To me is that trade component. When I look at how biofuels have expanded within the domestic market, we've grown very well, and we've been able to, you know, I think Mike's data showed that we sort of, if you will, filled that E10 blend. We're working on building up on the E15 side. We continue to see the domestic growth. But the oversupply situation leads us to wherever I look within agriculture or on the biofuel side. Typically, we depend upon having that ability to sell to overseas markets and seeing the growth, that potential that comes from that. And so as I'm looking forward over the next 5 years, I would say trade is our biggest challenge and our biggest opportunity going forward.
Very good. Thank you for that. Okay, audience questions. Looks like we've got a question here. As you ask your question, please tell us who you are, and if you would direct it to the person that you'd like to answer, one or both.
Jim Meyer, Sac County. Why should we assume that trade will suffer if we move from TPP and NAFTA to bilateral agreements?
You want us one or both to answer?
Any information I can get.
Well, I guess I'll lead off. It won't necessarily suffer. I think when we're coming here, if we do get bilateral agreements, we could see improvement. I think the question really is here is that we've seen the withdrawal from multilateral agreements without hearing any necessarily gain on the bilateral side. And I think, as I look at it, the idea is, can we gain through bilateral agreements? We definitely can. I see a lot of potential within that. But again, we're not hearing that discussion when I talk to the administration or talk to our trade representatives. Right now, most of our discussion is tied up in dealing with NAFTA right now. And so we haven't had the time or ability to really begin to work on those bilateral agreements that could help, if you will, offset what I see as the loss through losing TPP or through the renegotiation of NAFTA.
Anything to add, Mike?
No, not really. I mean, the U.S. is full of raw commodities. Again, the world demand, the need is out there. As we look further down the road, we will get a bilateral agreement, and trade probably won't be affected that much as far as that goes. So.
Okay. Great. We've got a question all the way in the back next.
Hi. My name is Peter Sherinian. I'm from Des Moines. A comment and then the question, because they're sort of related. A lot of people don't realize how effective and efficient, as well as less expensive, electric vehicles are. 2 to 3 cents a mile compared to what it costs for gas, which is usually around 8 to 10 to 11 cents, depending on the price. But on that same context, do we in Iowa have and or can put in place mechanisms by which we can adjust what we are doing in this industry, which is the energy industry, to accommodate especially something dramatic change that can occur? It's called invention. And for our farmers to produce products that we can make money from. And with that adjustment, something comes up with something new, and we can then adjust ourselves to that new invention and make a profit for ourselves, for our people.
Well, I guess I'll go back to, like I say, when I'm looking at agriculture, it's not that we adjust on a dime and immediately turn, but you have seen agricultural production in this state adjust to fit the energy needs of the time. Again, I go back to the 30s and 40s. Half of this state was in oat production because it made sense, because that was the energy source that powered the farm. And as I look today, and with nearly half the acreage in, half in soybean basically and half in corn, that same sort of thing. We're looking at where the energy demands are being driven now, and agriculture responds to that. As I look in the future, I would expect to see the same thing. And that's why even when I look at the possibility of electric cars growing in importance, I think agriculture would adjust to help fill the demand for the needs for energy for those vehicles as well.
Anything else to add, Mike?
No, I think it's well stated. So.
All right. We have another question here.
Good morning, John Norwood, TBL Ventures. Thanks, Chad and Mike, for your talk. So on the E15, I have a question. We sell natural gas by the energy unit, and we sell electricity by the energy unit. And when we pull up to a service station, somebody made this comment. Maybe it was Monty early. We're introducing more and more choice. We've got diesel, we've got E10, we've got E15, we've got E85. How can we possibly expect to have an efficient market if we don't know what's in those, the energy content that is in each gallon of those fuels? I just don't see how it happens. I'd be interested in your comments.
That's a very good question. It comes down to price. I think most consumers just go to the pump, buy whatever. But I don't know that if I can fully answer your question. We are offering we would be offering a lot of products. It's just going to have to take time. I assume we'll adjust, but initially it's all going to be about the price.
And I think, Mike's point to me is well taken. When I'm looking at how U.S. fuel consumers approach that choice, I'd say for the most part they're driven by price first off, and then they look for that octane number as their second sort of information point, if you will. That, if you will, our U.S. consumers haven't dove into a great study on the energy content, but they concentrate first on the economics, what's the price of it, second, the one number that they do know is that octane number, and then they concentrate on that. And so we won't see this evolution in how we market fuel, if you will, until consumers are ready to spend that time studying about the energy content of the fuels that they're buying.
All right, with that, that is the end of our time. Could you please join me in giving a big thank you to both Chad Hart and to Mike Blackford.